Check out the Savvy Investor podcast wherever you get your favorite podcasts, 866-597-1040 to reach out to Mike and Ryan and to get started on your retirement, because it is very important, also at thesavvyinvestorradio.com. All right, so everybody knows who's on the $100 bill. If you don't, there it is right there. It's Benjamin Franklin, the Hundy. Ben on the Hundy. Show me the Benjamins. Well, Benjamin Franklin, let's not forget, once said, the only two things you can count on in life are death and taxes. Until now, because Mike Kinnett put out a book called Nothing is Certain But Death and Taxes Until Now. But for this particular purpose, someone later said that may be true, but at least death doesn't get worse every time Congress reconvenes, and that's really good. But that's the thing, man. I mean, taxes and the laws change so much. They're constantly doing that. That makes us retirement savers go crazy. You guys know this because you guys are always up to date on this stuff. But there's something to be said about a low tax bracket with tax-free money as being a plus. And that's what I want to focus on here today. Ryan, let's talk about that, because that's the wheelhouse. Here we are, we save and we save and we save, and we think taxes are going to be lower when we retire, but that's not necessarily the case. Death is coming, and so are taxes, but it doesn't have to be.
It's one of those things that everybody always assumes that my taxes are going to be lower in retirement. And for some people that can be true, but for most people, taxes are the same, if not higher in retirement, because there's these myths out there that, I always see that or I hear from clients that, Social Security is not taxable. That's one thing that people say. For some reason, there's that myth out there. And then there's this magical age that exists somewhere where I don't have to pay taxes ever again because I'm so old. But, that's not ever really the case. And, the tax side of it is so important, and having tax-free money is so important. And tax-free means that it's not taxable to you on the federal level. It's not taxable to you on the state level as well. It doesn't trigger your Social Security to become taxable. And, it really doesn't matter at that point what happens to tax rates if all of your money is in tax-free accounts using Roth 401ks, Roth IRAs, certain types of properly designed cash value life insurance, and some of those triple tax-free muni bonds. And it's one of those important things. So that it's what Mike and I have been talking about with our clients for years and years and years. And really 2018 is kind of when we amped it up, because that's when the Trump tax cuts were passed. And what they did was they lowered the overall tax brackets and the tax percentages, and they widened how much income fits into each of those brackets. So instead of there being $150,000 fitting in the 22% bracket, it was like $350,000. And what that really enabled us to do is sit down with our clients and say, all right, here's what is going to happen. Here's what we know is going to happen. We know the tax rates are going to exist until 2026. After starting in 2026, tax rates are going back to the Bush level, and we just keep them at the Bush level all the way out until age 95. That's the age at which we plan to say that our clients pass away. They live beyond that, plans still work. You live less than that, it changes the numbers up a little bit. But what we're doing is we're saying, by doing nothing, by just continuing down the path that you're on, putting money in your 401k, your traditional 401k, keeping money in IRAs, and just saving the way you're saving, here's what is going to happen at a bare minimum for you in taxes. Here's how much tax you're going to pay on the federal level over your lifetime. Here's how much tax you're going to pay on the state level over your lifetime. 20, 30, 40 years of taxes. And for most people, it's a very, very large number. Millions of dollars is kind of what the average of what we see. And then we say, by doing Roth conversions, let's pay the taxes now, because I'm taking a complete guess at what tax rates are going to be 30 or 40 years from now. I'm just saying we're at the Bush rates and they stay there, because I think taxes are going to go up. It's whether or not how much they go up, but I don't want to guess at those rates. But by doing the Roth conversions over the next, when we started in 18, from 2018 all the way to 2025, but by doing Roth conversions over the next 3, 4, 5, 6, 7 years, here's how much money you're going to pay in taxes. But look further down the road how much less we're going to pay, potentially even getting you down to that 0% tax bracket. So here's, by doing Roth conversions, here's the exact same time frame, the exact same tax brackets, the exact same income level. Here's what you're going to pay in taxes, and here's the difference between the two of them. Oftentimes we're seeing savings of, $600,000, $1 million,
Wow.
even as high as $5 or $6 million over clients' lifetimes. And it's all because they choose to work with advisors who understand the tax code. If I can go back, if you remember the other client that I was talking about, where they were working with the self-proclaimed IRA expert, his group, they would often ask him for tax advice or often ask him about Roth conversions. And his answer was, well, it might be appropriate for you, but you really should talk to my buddy Tom. His name wasn't Tom, but my buddy who's a CPA that I refer all my clients to.
Sure.
And so they often found themselves being the middleman, which is not something that anybody ever wants to do. And so when they came in and they sat down with Mike, myself, and our team, we went over the plan. And for them, it was like $1.4 million that they were going to save on taxes. But more importantly, when you pass away, because nothing is certain but death and then taxes, just like Ben Franklin said, just like Mike's book, when you pass away, that money is going to go to the kids. By doing nothing, they were going to pay another $700,000 in income tax. But by having the tax plan in place, having your investments work hand in hand with that tax plan, here's how much more money the kids are going to save. So, we were saving them, I think, like I said, $1.3 million in taxes. And then for the kids, they were paying nothing when mom and dad passed away because mom and dad had already paid the taxes. Altogether, about a $2 million tax savings for this family. And it all was because they heard us on the radio and they said, let's give Ryan and Mike and his team a call at 866-597-1040, 866-597-1040, and take advantage of the tax planning and Roth conversion analysis that Mike and I provide for every single one of our radio listeners. We're going to talk about Roth conversion. We're going to talk about how we can reduce the amount of taxes that you're paying right now and in the future, and the savings we can pass on to the kids. But all of that starts by giving us a call at 866-597-1040, 866-597-1040.
Again, that's 866-597-1040. And I want to remind you about the SavvyInvestorRadio.com. Again, that's the SavvyInvestorRadio.com. You can also take advantage of that there as well. Click on the tax analysis button and get started that way again. So 866-597-1040 and at the SavvyInvestorRadio.com. And if you've saved $500,000 or more for retirement, that's really where the tax savings power of these strategies really start, and this analysis really gets going. So if that is you, first of all, congratulations. You've done an amazing job of savings. Now start to get with a plan for retirement, a tax plan for retirement. We brought this up, Ryan, and I wanted to go back to this because you were talking about Roth conversions. Now, you're not proposing everybody just go out and do a Roth. There is a systematic approach to this, a mathematical approach to this, to make sure that you're doing things right. So let's talk about the math on Roth for our listeners and viewers right now.
What makes it different, what makes Mike and I different is that before you come in to see us, I'm going to ask to see a bunch of information. Two of those things, number one being your tax return, and number two being your investment account statements. I want to see, how much you have inside of your IRAs, how much you have inside of 401ks. And then I want to see your tax return so I can figure out how much from those accounts we should be putting on top of your tax return, because the overall goal of what we're doing is, yes, to get everything out of your 401k, everything out of your IRA and over into these Roth accounts as quickly as possible. And some people ask, well, couldn't I just do, I have $1 million. Couldn't I just do all $1 million in 1 year? Yeah, you could. But all of a sudden that takes us from the 22% tax bracket into the 24 and then the 32 and then 36. So you're paying a lot more taxes on that money So your break even point might be farther. It might not make sense. So what we're doing with this Roth conversion analysis is we're looking at your tax return. How much money are you making now? What other sources of income do you have? And how much of what you have in your IRAs, or how much of what you have in your 401k can we add on to your tax return without, moving you over that next tax bracket? Or if I have to move you up into that next tax bracket, how can I do it without raising your taxes too much to where it doesn't make sense? And it truly is that cost benefit analysis. And, when you're asking your financial advisor about it, he's just saying, all right, well, you have, if we want to do it over 10 years, you got $1 million inside of your 401k. Let's just do $100,000 a year. And if you're looking at, you're talking to your CPA about it, he might say, all right, well, you're in the 22% bracket and you have about $50,000 more income you can add on before taking you up to that next income tax bracket. And you're getting really two different pieces of information. Neither one of them are communication. Neither one of them are saying, here's what's really good for you. Here's what the overall strategy should be for you. And that is what the tax planning and Roth conversion analysis does, is it says, here's exactly how much you should do in Roth conversion. And here's why. Here's the numbers behind why we're suggesting to do this. And you can look at it line by line, how the income differs every single year, all the way out until you pass away. Here's what the differentiation is in taxes. But that all starts by calling us at 866-597-1040, 866-597-1040, and sitting down with Mike and myself and our team here at Prostatis and going over your very own tax planning and Roth conversion analysis. 866-597-1040, 866-597-1040.
Teammates are actually standing by right now to take your call. So savvy investors will give you a little bit of time to do that. 866-597-1040, 866-597-1040, and at the SavvyInvestorRadio.com. Again, that's the SavvyInvestorRadio.com for the tax analysis and 401k Roth conversion analysis as well. That's the SavvyInvestorRadio.com.